So to get the best tax deductions in real estate, obviously, if you buy a more modern property, you're going to get a higher level of deductibility. You're going to get better depreciation. I'm looking at a piece of real estate today that actually has depreciation of over $85,000 per year. $85,000 per year. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to invert everything. Yes, Charlie Munger, yes, Warren Buffett's right-hand man for over 50 years, one of the best investors on earth, just said it the way it should be said. Don't overthink things. You don't think of what you want in this world. You think of what you want to avoid. And today I want to talk about inversion, really the idea that investors need to invert their logic. So let's crack on. I hope everyone's well. Welcome to the show. If it's your first time tuning in, we have some rules as urban property investors. We play this program in double speed to get our life back. But a little note, all the episodes I've done are actually lessons on real estate. So feel free to go back in time and see if you can find a lesson that may help you crack the code. And of course, here's my shameless plug. This is my new book. It's called The Australian Property Game. It's available on Amazon. It's full of tips and strategies on how to invest and really build a multi-million-dollar portfolio. So if you like the idea of maybe cracking the code with no BS strategies and building a $250,000 passive income playbook, then that is the book for you. And really, a big part of my days now is simply spent sharing information. And really, this podcast is all about sharing the gospel of Australian real estate. So today we're going to talk about inversion and the idea that we quite often need to start with the end game in mind with everything we do with real estate. I often get asked to look at some real estate which people have sort of put together themselves, or they have seen some clickbait somewhere and are quite excited about a certain concept in real estate. And really what they're quite excited about is effectively the headlines. And really what those headlines can do for their life. They are starting with the news coming to hand. And really one of the things I teach is to constantly invert everything. You don't think of what you want, you think of what you want to avoid. And real estate is very much a game of avoidance, risk management. I guess if I was to describe my role these days in what could be, described as quite often a very risky environment, a very volatile environment. If you think about what has happened over the last 5 years, from pandemics to spatial transformation to, political interference, to the Trump era, to wars in Ukraine and the Middle East. We are certainly living in a volatile world, and really the idea of real estate investments is really the idea of risk management. And I've always found over the years, risk management is best described using an inversion methodology. You just want to invert everything. So recently, I was asked to analyze a deal in Shepparton, and it was, a higher cash flow kind of strategy deal in Shepparton. And really on the numbers and the face value of the real estate, per the advertising, it looked like a high return. It looked like a magical deal, and so you could buy it on its magic, or you could invert everything. And so inversion is really about going, what do you think you want to avoid? And really, with that particular opportunity, it was pretty easy to go, well, okay, let's take a look at the climate risk rating of Shepparton. And Shepparton's one of those sort of places that may end up becoming a bit of a Lismore, because it's got a lot of flood risk, it's got a lot of fire risk, and it's got a lot of housing commission risk. And so does it make a great investment area, knowing that you can get a high yield there on a certain typology of real estate on its face value, but digging deeper, will it actually become a climate risk marketplace whereby you can't actually get your property insured? And if you can't get your property insured, then a lender's not going to lend money on an uninsurable property. So does the property become illiquid? Does it become a property whereby you could never on-sell it to someone else unless they were paying cash? And so the idea of starting with the end game is really the idea of inverting the conversation piece around real estate. Inversion therapy. We've heard about conversion therapy. Now we're talking about inversion therapy. To invert, always invert. And so you can invert kind of anything you want, really. It's really about looking at what you need to avoid and doing something about it. And you can invert really what you want from real estate as an investment. Like, you think about how long you might be retired for, how much money you're going to need in retirement. Really, that's a mathematical equation. You might want to have $100,000 passive income in retirement. Well, you've got to actually then go, okay, well, how many pieces of real estate do I need to be successful to achieve that? And what type of pieces of real estate, and where and how should I build a portfolio? And so always inverting the conversation is an important concept. And pilots use this a lot. When the Qantas aeroplane, the A380, was flying over Singapore, and, a piece of the plane, burst off the plane, and the plane was, potentially going to crash. The pilot, one of the things he talks about is not working on things he wanted the plane to do, but thinking about what the plane also needed to avoid further beyond the problem to resolve, obviously, a safe landing. And he inverted everything. And so it goes down in sort of aviation history as one of the most amazing escapes of a plane problem, because the pilot was very in tune with just looking over the horizon and going, how do I avoid even more problems? So that's the job of a property investor, is to find problems and deal with them, and avoid as many of them as possible. And so, though that deal in Shepparton had a high face value yield and probably would put a couple $100 a week in your back pocket, will it actually end up being a terrible decision 5 years from now if Shepparton was to flood or there was a big bushfire? Because when you look at the data does not support that it's a climate resilient resilient marketplace. So I'm sure the premium of the insurance would negate the cash flow. Now, I teach a model, my asset selection system. It's got sort of four components to the model: capital preservation, growth, yield, and tax deductions. And so capital preservation is one way to think about inverting anything: growth, yield, and tax deductions. And even in that model, if you think about how it's laid out, which is how I just described it, capital preservation, which is just the idea that you don't want to lose money. You want to preserve your investments. You don't want your investment to be a risky investment. You want growth on your asset. You want cash flow on your asset. And you want to be able to use the Australian tax system to also, collect and reduce your taxable income. That's the beautiful thing about Australian real estate and many asset classes. It's also linked to your taxable income. So one of the things that quite often, is a good way to think through real estate is the inversion of my asset selection system, my 4-quadrant asset selection system. So if you were to invert it, you would start with tax deductions. So to get the best tax deductions in real estate, obviously, if you buy a more modern property, you're going to get a higher level of deductibility. You're going to get better depreciation. I'm looking at a piece of real estate today that actually has depreciation of over $85,000 per year. $85,000 per year. So depreciation is just one of those kind of things that if we invert the logic, we may end up actually reducing the risk of real estate by using depreciation. And I'll explain, I guess, this inversion concept as we talk about it. But as you know, with real estate, if real estate has not gone through any significant renovation and a property is built pre-1986, it doesn't qualify for depreciation. So you can't use the real estate to create annuity. You can't use the real estate to create cash flow from the tax situation or depreciation. Real estate that is, circa 20 years old, you typically can claim the building depreciation, but you can't claim the internals, the chattel depreciation, the kitchen, the carpet, the blinds, the light fittings, the flooring, all that kind of stuff. So the more modern you go, the more you can create a depreciation allowance, which is effectively taking the asset and turning it into income, taking the asset and changing the trajectory of the cash flow on the asset. And so depreciation is a pretty amazing thing because you effectively are liquefying your capital, which is in a bricks and mortar, and you're turning it into cash flow. Now, again, if we invert the 4-quadrant investment selection system, which is capital preservation, growth, yield, and tax, if we improve our tax deductions on the asset, we are going to get more cash flow, which if we invert the 4-quadrant investment selection system, we're going back to yield. All of a sudden, because we're getting a higher level of cash flow from depreciation, because a property is more modern, the yield does not need to be as high to effectively create the same level of holding costs to hold the real estate. Now, again, when you are chasing very high yields, you typically are leaving growth marketplaces. Quite often you will find that inside of a return, that if a rental return is, effectively at a gross level pretty high, like 6, 7, 8%, which sounds great on paper because you would have a cash flow neutral, cash flow positive investment. What we know about cash flow positive investments, if they're not cash flow positive by virtue of basically time, they are quite often in low growing marketplaces. So they're cash flow positive because the rents have grown faster than capital growth. And capital growth is missing from the investment. So when you don't have and we're inverting my 4-quadrant investment selection system here, when you don't have good deductions and cash flow from tax, you've got to be reliant on producing more income from the natural rent and pushing the cash flow up from the natural rent. But quite often that means you effectively end up in a place where you're choosing a lower growth asset, So again, like inverting the logic by putting a decent level of tax deductions on the asset, you can actually buy yourself a medium level yield, a 4, a 5% return gross, which is typically from a growth position in a stronger growth proposition market than a yield which is at a 6 or 7 or 8%. I know that kind of sounds counterintuitive, but that's the way the world works. The highest capital growth marketplaces are the lowest yielding. So if you want a rate of capital growth of 8, 9, 10% capital growth, you've actually probably going to put yourself in a position where your yield is 1%, 2%, very, very low. And this is where total return plays a part. If we're choosing a certain yield, we're also choosing a certain rate of capital growth. The capital growth plus the yield is the total return. So again, like if we invert everything and we get good depreciation, we all of a sudden can open up ourselves to a medium level yield. And then between the depreciation and the yield, we cover a large proportion of the after-tax cash flow to hold a property investment in our portfolio. Now, obviously, there's a burn rate on real estate, and the highest growing properties in the marketplace are extremely expensive to own, like $1 million a year, like very expensive. They're the highest growing. They'll grow at $2 million a year, but it'll cost you $1 million a year in cash flow to make $2 million a year in growth. Or it'll cost you $50,000 in cash flow to create $150,000 in growth. So there's this trade-off for property investors. How much do they want to burn from their back pocket to effectively create capital growth from an investment? And obviously you don't want to burn money just, burn money in the pursuit of the wrong capital growth strategy. So you've got to align that up. Now, tax deductions are a benefit of real estate. They are not a principle of real estate. They're simply a benefit. principle of real estate is asset to land ratio, asset to space ratio. Principle of real estate is adding value to real estate. Principle of real estate is, location economics, walkability, livability. These are all principles of real estate. Where people want to live is probably one of the most important principles of real estate. So you don't want to invert a tax deduction on a unlivable brand new market lemon property just to soften the yield, because that's not going to work either. But just as a demonstration to explain inversion, if we've got the right design-led property, it's got the right depreciation, it means that our yield is boosted from the depreciation, which means our after-tax cash flow is not burning a hole in our back pocket, which means that we can afford to buy time. Now, real estate investment is generally a time-bound concept. It doesn't happen overnight. It's not like the stock market. It's not like Bitcoin. Price movement can go up in a month, but it is generally measured over a decade and longer. And so the right depreciation, the right yield equals the right after-tax cash flow, which equals time in the market. And time in the market allows for capital growth. And capital growth is really that second part of the 4-quadrant investment system: capital preservation, capital growth, yield, tax deductions. So again, like all of a sudden we've bought ourselves a good yield, starting with the end game in mind, with a decent market rate return with a tax deduction. And because we haven't chased yield just to the point where we need positive cash flow, because that would be low growth, we've ended up putting ourselves in a better position now that the yield has stabilized our world, that we can focus on a high quality asset in a growth area. And that just allows us a higher rate of growth. Now, the rate of growth is one of the most important principles of real estate investment. The rate of growth is effectively a mathematical equation. A 7% rate of growth, i.e., the compounding effect of the real estate is 7% per annum. That would mean real estate would double in 10 years. 6% per annum is about 12 and a half years. 5% per annum is closer to 15 years. So we want to put ourselves in a position where the depreciation, the yield allows us to buy the right rate of growth, which allows for the real estate to grow in value, but not at the burn rate where we're losing money out of our back pocket. And so when we've got a good growth asset, our capital is preserved. Our capital is preserved, capital preservation, because we've been able to stabilize the asset. We've got it in a growth market. We've got time on our hands. All of a sudden, we know our capital is going to be preserved. So that's one way of inverting a concept of real estate. And really, you can invert all sorts of things, not just my 4-quadrant investment selection system. Just wanted to use that as an example today of how to think through risk management with Australian real estate. There's a lot of risk out there, whether it's climate risk, whether it's obsolescence risk, whether a property is past its use by date, whether it's got hazardous materials connected to it, whether the land could end up, being in a serious flood, whether there's too much noise in a street, whether the home is too far away from transport. Like, you've got to invert everything you look at and look at it from a different lens. And that allows you to be a good risk manager with real estate investment. Really, if I was to summarize my job, I am a risk analysis of real estate. That's really what I do. And to the frustration quite often of people I work with who are less experienced than me, I sign off on most of the deals we do, and I will reject a lot of them. And, quite often younger people in the buyer's agency, investment agency space, get a little frustrated because of the risk aversion that I put on real estate. It's all about inverting things, like what could go wrong, where could it go wrong, and why could it go wrong. And all is not what it seems on face value. Real estate agents sell real estate that is full of problems. And so as an investor, our job is to solve those problems. The more of them we can solve without physically owning the property, the better. The more we can solve through decision matrix, the better off we're going to be. But hey, guys, I hope that was interesting. I'll keep it short and sweet today. Take care. We'll talk again soon. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.